Hello, I'm the squasher of Regulatory Impositions, aka the SRI. Here's a number that might surprise you: $331,000. That's how much tax-free retirement money you could build over the next 20 years just by using your HSA the right way. If you make over $500K a year, there's a good chance you're making at least 3 mistakes right now that are quietly costing you thousands in missed tax savings and growth. Today, we're diving into advanced HSA strategies that turn this little health account into a powerful wealth tool. Okay, so let's start with the basics. You probably know that an HSA gives you a triple tax break like no other. Money goes in tax-free, it grows tax-free, and it comes out tax-free when used for medical expenses. But if you're making $500K or more, basic advice isn't enough. Your taxes are bigger. Your strategy has to be smarter. So here are 5 strategies or 5 ways to make the most of your HSA. We'll show you how to save more on taxes today, build more tax-free money tomorrow, and stay 100% compliant along the way. Okay, let's get into it. In 2025, here are the limits. $4,300 if you have individual coverage, $8,550 if you have family coverage. So let's say you're 50 years old, married, and earning $650K a year. You have family coverage through work. That means you can contribute $8,550. Now, if your spouse has their own individual HSA at their job, they can contribute $4,300 too. Together, that's $12,850 per year. A 37% tax rate, putting in $8,550 saves you $3,164 in taxes. Do that every year for 20 years, and you save $63,280. Let it grow, and your HSA could be worth $331,000 or more, all tax-free. Okay, so many employers match your HSA contributions, but here's what most people get wrong. They front load their contributions in January. Most employer matches happen per paycheck. If you put in your full amount early, you might miss out on that match later. So spread out your contributions evenly throughout the year and get the full match. And if you want to top off later, do it before April 15th the following year. For example, if it's March 2026 and you realize you were in a higher tax bracket in 2025, you can still make a 2025 HSA contribution and reduce that tax bill. Okay, so if you change jobs mid-year, watch out. So let's say your old job added $2,000 to your HSA. Now your new job also has an HSA. Careful, the IRS limit is combined. The $8,550 cap applies to everything you and your employers add. Go over and the IRS hits you with a 6% penalty every year until it's corrected. Avoid that. Track all contributions, yours and theirs. Also know what's called the last month rule. If you have coverage on December 1st, you might qualify for the full year limit. Now here's a bonus tip. Negotiate for HSA bonuses as part of your new job offer. Okay, so let's say you start the year with individual coverage and switch to family coverage in July. Can you contribute the full family amount? Yes, if you have family coverage on December 1st. There's a catch. You have to keep that family coverage all the next year. If you don't, you could get hit with a tax penalty. IRS doesn't give grace periods for confusion. It expects you to know the rules. Track your coverage type every month. When life changes, marriage, divorce, switching jobs, make your strategy. Your spouse inherits your HSA, get it tax-free, and it becomes their own HSA, no problem. If anyone else inherits it, the entire amount becomes taxable income then that year. Here's a smart move. Pay medical expenses out of pocket and save the receipts. Executor can use the HSA to reimburse those bills within 12 months of your death. 3. Protects part of the account from becoming taxable and passes more value to your family. Now here's one more trick. You have until April 15th to make HSA contributions for the previous tax year. Gives you time. You get a big bonus in December. January or February, you can make a retroactive HSA contribution for the prior year and lower your tax bill. Example, add $8,550, you save $3,164. It's that simple. So let's wrap it up. Are your 5 HSA power moves? Number 1, max out your contributions. 2, spread them out to capture your full employer match. 3, track every contribution through job changes. 4, adjust your plan when life events happen. Or 5, use smart estate planning to reduce taxes. Right, you could save $3,000 to $6,000 per year in taxes and go over $331,000 tax-free for retirement. Loopholes. There are legal advantages to into the code for high earners who know how to use them. Found this helpful? Tap a like and subscribe. We'll continue to explore building your comprehensive tax optimization roadmap.